The back half of 2022 was pretty rough, but it set us up for what I think is going to be a really good opportunity to buy cash flowing businesses in 2023. Hey, I'm Ray Drew, an actual SBA lender, and in this video, I'm going to tell you exactly what buyers should be looking for when searching to acquire a small business in 2023. These last couple of years were nuts. I saw business after business sell, coming off record-breaking year, which gave the seller the highest valuation their company's ever seen. We're talking e-commerce businesses, home service businesses, businesses in the trades, any business in Florida and Texas. Buyers acquire these businesses for the most part with adjustable rate SBA debt, and now the rates have almost doubled in less than a year and the economy has slowed. So if all that is true, why is now such a good time to buy a business? Well, let's take a look back to the first half of 2022. The majority of businesses that I financed were coming off those record-breaking 2021s, which continued into Q1 2022. And when I'm looking at a deal and I see recent growth, I always ask, is this growth expected to sustain? And what do you think every broker and every seller said? Yeah, well, for many businesses, it didn't. The back half of 2022 slowed down, and 2023 forecast isn't looking great. But some sellers will still need to sell, whether it's retirement, medical issues, relocation, or maybe they're just tired. Now, while economic uncertainty and recessions are certainly bad overall for business, it creates an environment of opportunity, and you can actually get a good deal now versus the last couple of years where sellers were naming their price and terms. And I think that the creative, resourceful entrepreneur willing to jump into the deep end are ultimately going to come out on top. You just have to be able to mitigate the risks. And in this video, I'll tell you how. On the plus side, the multiples for small businesses are still very reasonable. You can buy a business for anywhere from 2.5 to 4.5 times annual earnings. So if the business is down a little bit this past year compared to the previous year, it means you're going to get that business at a discount. Now, if you bought that same business 6 months earlier, chances are you would have overpaid. So let's talk about what a good deal looks like in 2023. Let's start with the business itself. Considering we're heading into a potential recession, I would highly recommend focusing on a non-discretionary business. HVAC businesses, landscaping companies, home health care, products and services that people need, not just want. Next, how do you come up with a valuation? You have to price the transaction correctly in this type of environment, or any type of environment for that matter. Now, there's two main factors going into the valuation. It's the multiple and the amount of seller's discretionary earnings, or SDE. And your SDE times your multiple is your valuation. So let's say you have a business with $1 million of annual SDE. Times that by a 3x multiple, that gives you a $3 million valuation. Pretty simple. All right, now let's use it in an example, okay? Let's say you agree to a 3.5x multiple. Okay, well, what am I multiplying that against? Now, a lot of buyers and sellers will agree to multiply that against the trailing 12-month P&L. Right now, it's January 2023. Does it make sense to base your valuation off financials that are going to include Q1 of 2022 before the Fed started jacking up rates and wrecking the economy? I don't know. And what about the SDE number itself? You really have to dig into those financials to determine how accurate that number really is. You may even want to get a quality of earnings report done. Ask yourself, when did the employees last get a raise? Are they being paid market wages right now? Are all the employees on the books even? What will my rent be? Understand cost of goods sold and any recent pricing adjustments that the business had to make to account for inflation. Normalize all of these expenses and then calculate the SDE. Now, once you have your price, it's time to structure the deal. One aspect of your deal should be seller financing, at least 10%. The last thing you need is for something critical to happen to your business 6, 9, 12 months in, and you can't get a hold of the seller. The seller note promotes transparency and keeps the seller, who's extremely important to your success, dialed in post-close. Your equity injection, the amount of money you're putting into the deal, that's another aspect of the structure, really important one. 10% is the minimum for SBA. Now, some lenders may push for a little bit more, 15, 20, 25%, but honestly, I disagree. Cash is king always, but especially in times of economic uncertainty. And the amount of debt service you're going to be saving is peanuts compared to the importance of having some extra dry powder during these times. And that brings me to my final aspect of the structure, which is the working capital. Don't make the mistake of closing a deal without having adequate working capital in the bank. The SBA allows the lender to build in working capital to cover those business expenses during that critical transition period. That's money that gets deposited into the business bank account day one so that you can keep the lights on while that money starts rolling in. And not every lender sees it that way. Many lenders are going to limit that number to limit their own exposure and their own risk, but actually it's to their own detriment, because the number one reason a deal goes bad in year one is lack of working capital. So if you sense that your lender is limiting you on working capital, run. One other thing I've been doing in light of all the supply chain issues is actually providing some additional funding for inventory. I recently financed the acquisition of an e-commerce business where the seller wasn't stocking enough inventory because he liked to run lean, and so sometimes products were sold out. And obviously the buyer wanted to have that inventory to be able to make more sales. So we built in some inventory into the structure, and at closing, the buyer supplied us with an invoice and we paid that vendor to buy some additional inventory for the business. That way, the buyer could focus on growing the business without having to worry about running out of inventory. So again, what we're trying to do is set the business up for success as much as possible. And for me, that means keeping the buyer as liquid as possible. So with that in mind, let's go back to the 10% equity injection portion of the structure that I mentioned earlier. The SBA allows the seller to contribute up to half of that 10% equity in the form of a seller note, which gets placed on full standby for the life of the loan, meaning they can't collect any payments until the SBA loan's paid off, and it's usually a 10-year loan. But this allows the buyer to come in with only 5% down. Now, why is that good? Well, number one, you can preserve your capital. But number two, maybe you didn't have the capital to inject in the first place. Maybe this structure allows you to buy a business bigger than what otherwise would have been possible. And that in and of itself helps de-risk the transaction, because your larger businesses tend to have less seller dependency, more infrastructure, and better quality financials to analyze. You have your business, you have your price, you've structured the deal. Now let's see if it works. To do this, we're going to look at debt service coverage ratio. Let's take a look at an example here. So let's say you're buying a business with $500,000 of annual SDE and you're paying a 3.5x multiple. That gives you a purchase price of $1.75 million. And for the sake of this conversation, let's just say you need an additional $125,000 for working capital, and closing costs are going to be around $50,000. That brings your total project to about $1.925 million, and you're going to finance 90% over 10 years at, let's say, 10%. The annual debt service on that is going to be $275,000 a year. All right, now let's dig into the debt service coverage ratio. This is really important. It's really the crux of SBA lending. So remember, we have $500,000 of annual cash flow to play around with. Let's assume you'll need to pay yourself $60,000 to cover your own personal debt and expenses. That leaves $440,000 to cover $275,000 of annual debt service. A debt service coverage ratio of 1.6. That means after you pay all of your expenses, yourself, and your debt, there is $165,000 of excess cash flow. But Ray, we're still in a rising interest rate environment. What if the rate goes up? That is very true, and that's why it's very dangerous to buy a business that doesn't have plenty of debt service coverage. When I look at a deal, I increase the rate by 2% and 3% to see how that impacts the debt service coverage. So let's take a look. Here's what the deal looks like with a 12% rate. The debt service coverage ratio drops from 1.6 to 1.48, which is still pretty comfortable. Now, obviously these numbers are compelling, but I would be doing you a disservice if I told you that this was easy. Running a business is hard. Before you do this, please go get some experience in an entrepreneurial setting. Manage something, manage people, manage a P&L. Those are the types of basic skills that will translate to just about any business that you buy and get you better prepared for when it's your turn to jump into the deep end and sign that PG.
So there you have it. If you found that video helpful and you want more expert advice from an actual SBA lender, then I would invite you to hit that subscribe button, because I've got plenty more where that came from.